$765.20. That is the number flashing on the screens right now, with the stock effectively flat for the intraday session at 0.00% movement as we speak. If you were looking at the after-hours or pre-market data, depending on when you were seeing this, you might see slight fluctuations, but the story right now is one of stabilization after a significant volatility event. You are looking at a stock that has recently seen a massive shakeup, dropping significantly over the last few sessions, down nearly 9 to 11% recently, hovering near levels we have not seen in months. Most investors seeing a chart like this immediately think correction or trouble. They see a high-flying tech stock finally coming back down to earth, punished by a market that is suddenly skeptical of high valuations and aggressive spending. That is the expectation. The narrative currently dominating the headlines is that ServiceNow is overreaching, spending billions on acquisitions like the potential $7 billion Armis deal and the just completed MoveWorks purchase, and that this capital expenditure is a risk to their margins. Investors are worried that the company is trying to buy growth because organic innovation has stalled. That is what the bears want you to believe. That is the surface-level noise you will find on every forum and financial news ticker today. But the reality, the deeper truth that the algorithms and the retail panic sellers are missing is that this pullback is not a sign of weakness. It is a recalibration of the entire enterprise software landscape, and ServiceNow is arguably the only company positioning itself to win the next phase of artificial intelligence. While the market freaks out about the price tag of an acquisition, they are missing the fact that ServiceNow is systematically building the AI operating system for the entire corporate world. We are not talking about a chatbot that writes emails. We are talking about agentic AI, autonomous agents that can fix servers, route cybersecurity threats, and onboard employees without a human ever touching a keyboard. The drop you are seeing to $765.20 is not a sell signal. For the astute observer, it looks suspiciously like the kind of capitulation event that flushes out the tourists before the next leg up begins. This is not about IT help desk tickets anymore. This is about automating the enterprise itself. Let's dissect exactly what is happening with the price action, because it tells a fascinating story of institutional rotation. The stock has been hammered recently, falling from highs that were well above $800, approaching $900 not long ago. When you see a high-quality name like this shed nearly 10% in a matter of days, it is usually triggered by a specific catalyst. In this case, reports surfaced that ServiceNow is in advanced talks to acquire the cybersecurity firm Armis for roughly $7 billion. The market hates uncertainty, and it hates massive cash outlays even more. The algorithm-driven trading desks at firms using platforms like Interactive Brokers immediately sold off on the news, fearing dilution or just a hit to the balance sheet. This reaction is classic short-termism. You saw similar reactions when Facebook bought Instagram or when Google bought YouTube. The market looks at the cost today. The visionary looks at the moat tomorrow. If this deal goes through, ServiceNow stops being just a workflow company and becomes a dominant player in asset intelligence and security, sectors that are non-negotiable for every Fortune 500 company. Furthermore, we just had confirmation of the MoveWorks acquisition completion. This is critical. MoveWorks is not just another bolt-on. It brings advanced conversational AI that actually understands context. When you combine this with the sheer amount of data ServiceNow already holds about every employee, every device, and every IT process in a company, you get a synthesis that is incredibly hard to replicate. While you might be checking your positions on the Robinhood app or looking at your long-term holds in your Schwab Intelligent portfolios, wondering if you should cut losses, the institutions are likely doing the math on what this company looks like in 3 years, not 3 days. The fear in the stock price right now is arguably the premium you get to keep if you understand the long-term thesis. We need to address the agentic AI factor because this is the buzzword that actually means something. Most people hearing about AI think of ChatGPT or maybe the NVIDIA stock surge that fueled the hardware boom. But hardware is useless without software that actually does work. Up until now, AI has been great at generating text or images. It has been terrible at executing tasks. You can ask an AI to write a plan to fix a server, but it cannot actually log in and fix the server. ServiceNow is changing that. They are building agents that have permission to act. Imagine a scenario where a security alert goes off at 3 a.m. Instead of waking up a human analyst, a ServiceNow agent identifies the threat, isolates the affected device, patches the vulnerability, and files a report, all in seconds. This is the holy grail of enterprise efficiency. This is why the valuation is high. You are paying for the future of work. When you compare this to Salesforce, which is pushing its own agentic narrative, ServiceNow has a distinct advantage. They own the IT infrastructure layer. It's much easier to automate a workflow when you already control the database of record for IT assets. This is a nuance that casual observers using SoFi Invest or checking Fidelity mutual funds often miss. They see software and group it all together, but structured data is the fuel for agents, and ServiceNow has the purest refined fuel in the industry. Let's look at the technicals because the charts are screaming for attention at these levels. With the price sitting at $765.20, we are testing major support zones. The RSI on the daily chart has dipped deep into oversold territory, levels we often associate with a bounce. When a stock like this gets extended to the downside, the rubber band effect tends to kick in. You might see traders on Interactive Brokers stock trading platforms setting buy limits right around the $760 mark, expecting a technical rebound. The 200-day moving average is often the line in the sand for long-term trends, and we're flirting with key psychological levels. If you look at the volume during this sell-off, it has been elevated, which suggests a capitulation. The weak hands are folding. The investors who bought at the top because of FOMO are selling at the bottom because of fear. This transfer of equity from impatient retail capital to patient institutional capital is a tale as old as the market itself. Consider the broader market context. We are seeing a rotation. Capital has been flowing out of software and into other sectors, or focusing heavily on the hardware winners like NVIDIA stock. But hardware is cyclical. Software is sticky. Once a company rips out its legacy systems and installs ServiceNow, they almost never leave. The switching costs are astronomically high. This stickiness creates a recurring revenue machine that is the envy of the industry. Even if the economy slows down, companies can't simply turn off their IT backbone. They might fire employees, but they won't fire the software that allows the remaining employees to do the work of 10 people. In fact, in a recession, ServiceNow becomes more valuable because it is a deflationary force. It allows companies to do more with less. So when you see a red day or a flat day like today, you have to ask yourself, is the business broken or is the price just wrong? Now, I want you to take a second and engage with this idea. Comment below how many shares of ServiceNow you currently hold, or if you are waiting for a lower price entry. Are you watching the $750 level, or do you think the Armis deal is a mistake? Let me know your thoughts in the comments. It's always interesting to see where the sentiment is among real investors versus the Wall Street analysts. Moving back to the competitive landscape, we have to talk about the Magnificent Seven effect. Everyone owns Apple stock. Everyone watches Tesla stock. These are the crowded trades. ServiceNow is often the quiet giant in the portfolio. It doesn't have the consumer brand appeal of an iPhone or a Model Y, but it has the stranglehold on the corporate wallet. When a CIO at a major bank or a healthcare giant gets their budget for the year, ServiceNow is a line item that gets approved first. It is utility-like in its necessity, but growth-like in its expansion. You can trade fractional shares of this on Robinhood or hold it in a Fidelity IRA, but the thesis remains the same. You are betting on the digital transformation of the global economy. The competitors like Atlassian or BMC Software exist, but they often lack the breadth of the Now platform. ServiceNow has successfully expanded from IT to HR to customer service and now to creator workflows. They are eating the entire enterprise software stack from the inside out. Let's discuss the risks because we must be balanced. The valuation is rich. Trading at a high multiple of earnings means the company must execute perfectly. Any slip-up in growth rates, any guide down in subscription revenue, and the stock can get punished severely, as we have seen this week. The acquisition of Armis, if it happens, brings integration risk. Merging two massive cultures and tech stacks is never easy. There is also the macro risk. If interest rates stay higher for longer, the discount rate applied to future cash flows hurts high-growth stocks the most. This is why you see volatility. It's a constant tug of war between the growth story and the cost of capital.